Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions, and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
Japan's inheritance tax tops out at 55%. One of the highest rates in the world. If you're a foreign resident, does that rate chase everything you own worldwide, or just what's sitting in Japan? The honest answer isn't decided by how many years you've lived here. It's decided by the visa you're holding. This is the second video in our series on the tax, visa, and legal traps that actually decide whether a Japan real estate investment works out. Last time, we covered the capital gains trap when you sell Japanese property. This time, what happens to everything you own when you die? Japan's inheritance tax runs on two separate questions. First, where is the asset located? Second, what's the residency and visa status of the people involved? Start with the easy half. Any asset physically located in Japan, real estate, a bank account, Japanese stocks, is subject to Japanese inheritance tax no matter who owns it, where they live, or what passport they hold. The harder question is what happens to assets outside Japan, an overseas brokerage account, property back home, a foreign pension. That's where residency and visa status actually start to matter. The popular version you'll find in most expat forums: live in Japan less than 10 of the past 15 years, and your worldwide assets stay untouched. Stay longer, and everything becomes fair game. That's directionally true, but it skips a requirement that decides whether the years even count in the first place. Japanese immigration law sorts every resident status into two groups, officially called Table 1 and Table 2. Which table you're on controls whether the years-based exemption is even available to you. Table 1 is built around work, engineer and specialist in humanities visas, business manager, highly skilled professional, instructor, intracompany transferee, and similar work-based statuses. Table 2 covers a different category entirely: permanent residents, spouses or children of Japanese nationals, spouses or children of permanent residents, and long-term residents. Here's the trap. The years-based exemption, the one everyone quotes, only applies to people on Table 1. If you're on Table 2, your worldwide assets can become taxable in Japan far sooner than the popular 10 years rule suggests, sometimes almost immediately. For an actual Table 1 visa holder, the exemption works like this. If you've had your registered address in Japan for 10 years or less out of the past 15, you qualify as a temporary foreigner, and your overseas assets are excluded. A business manager visa holder who moved to Tokyo 8 years ago is still under that 10-year threshold, worldwide assets excluded. The same 8 years for someone on a permanent resident visa changes nothing, because Table 2 was never eligible for this exemption at all. Now the part that applies no matter which table you're on: how much of any estate is actually taxed. Every estate gets a basic exemption before any tax applies: 30 million yen, plus 6 million yen for every legal heir. One heir, no spouse, the exemption is 36 million yen. Only the amount above that gets taxed at all. What's left after the exemption is taxed on a progressive scale, 8 brackets running from 10% up to 55%. The lower brackets, 10% on the first 10 million yen of taxable share, then 15%, then 20%, then 30% as the amount climbs. The upper brackets climb faster, 40%, 45%, 50%, and finally 55% on any taxable share above 600 million yen. Run this against a real number, a foreign resident's estate worth 150 million yen, a mix of savings and overseas investments, passing to a single heir. After the exemption, 114 million yen is taxable. Run that through the bracket table, and the tax bill is 28,600,000 yen, about $176,543. For decades, Japanese estate planners have used one well-known move to shrink that number: convert cash into rental real estate before you die. Rental real estate isn't valued at market price for inheritance tax purposes. Land gets a discount for having a tenant's building on it, and the building itself is valued well below what it would sell for, commonly landing around 60% of its market value. Convert that same 150 million yen into rental property held long-term, and it's assessed at roughly 90 million yen for inheritance tax purposes instead of its full value. Taxable share, 54 million yen. Tax owed, 9,200,000 yen. Compared to holding the same value in cash, that's 19,400,000 yen less tax, about $119,753, for owning the exact same amount of wealth in a different form. That gap is exactly why real estate has been the go-to inheritance tax strategy in Japan for so long, foreign and Japanese families alike. In March 31, 2026, that strategy got a lot narrower. A new rule, effective April 1, 2026, targets rental real estate bought shortly before someone dies, specifically, property acquired within 5 years of the inheritance. Buy rental property within that window, and it no longer gets the traditional discounted valuation. It's assessed much closer to what you actually paid for it, closing the loophole for last-minute estate planning. The rule applies to property acquired by inheritance or gift from January 1, 2027 onward. It's already law, it just hasn't started biting yet. Same 150 million yen, same rental property, but purchased less than 5 years before the inheritance. Under the new rule, it's valued around 95% of market value, 142,500,000 yen. Taxable share, 106,500,000 yen. Tax owed, 25,600,000 yen. That's 16,400,000 yen more, about $101,235, than the same property would owe if it had been held long-term instead of bought right before the inheritance. The traditional discount hasn't disappeared. Long-held rental property still gets it. What's gone is the version where you buy property specifically because someone's estate is closing soon. This matters for anyone holding investment property with aging parents or a spouse, anyone weighing a late-stage real estate purchase as estate planning, and anyone on a Table 2 visa who assumed the years-based exemption applied to them too. Two traps stack here. The worldwide asset exemption depends on your visa table, not just your years in Japan. And the real estate discount that used to soften the tax bill now depends on timing you can't fix after the fact. Quick recap of the numbers behind Japan's inheritance tax for foreign residents. Basic exemption, 30 million yen plus 6 million yen per heir. Top rate, 55%. Worldwide asset exemption, Table 1 visas only, under 10 of the past 15 years. Check this against our capital gains tax video if you're modeling what happens to an inherited investment property when it eventually gets sold, not just when it's inherited. That's the real structure behind Japan's inheritance tax for foreign residents, and the visa and timing details most guides skip. Subscribe for more data-driven breakdowns of real estate and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.